Good morning, everybody. Welcome to Macalvins' webinar on unclaimed taxes. We're going to see if we can help you get your share of the 84 billion of unclaimed tax reliefs that are out there. I'm joined this morning by my esteemed and seasoned colleague and director, David Siegel, and also my learned colleague, Kaya Doshi. So, as they say, death and taxes are the only two things that are certain. And whilst we won't be able to help you with the former, although I think we do have an article on our website on wellness, we'll try our best to help you with the latter. So without further ado, let me introduce you to David, who will take us through our first topic. Thank you, David.
Thank you, Tarek. And thank you, everybody, for joining us this morning and sacrificing this rather fine weather that we look like we're having today. I'm going to start off today by talking to you about personal tax allowances. Many of you will be familiar with these. The first of which I want to mention are just the individual allowances. This is the tax-free amount of our income that we are allowed to earn. It's currently a figure of £12,500. But the important thing to remember about the personal allowance is that if you're in higher income bracket, over £100,000, this relief is actually reduced by £1 for every £2 that your income would exceed £100,000. This means that we have the rather unfortunate and I suspect unexpected consequence that that bracket of tax is actually the highest that anybody suffers because it's an equivalent of 60%. So those who do earn between £100,000 and £125,000 are actually paying tax at an effective rate of 60%. But nevertheless, the £12,500 personal allowance is very useful. Now, one of the devices included within the rules on individual allowances, which some people perhaps are not aware of, is something called the Marriage Allowance. And this is a transferable element of the £12,500. It's £1,250, which can be transferred between spouses in certain circumstances. And those circumstances are that you have to be married or in a civil partnership. One of you is not a taxpayer or has income below £12,500. And the other partner must pay tax at basic rate. So this marriage allowance is not available for those who pay higher rates of tax. But if the circumstances fit, it can be useful and it can save up to £250 to transfer £1,250 of your personal allowance to your spouse if those circumstances exist. Blind person's allowance, I have to mention this, although hopefully it won't apply to any of you, and it doesn't apply to a great number of people because you have to be a registered blind person. But for the sake of completeness, it currently sits at £2,500. Which I suspect most of us would consider is a little bit derisory for people who don't have their sight, but nevertheless, it is still there and available for registered blind persons to claim. Next item on the slide, dividend allowances. I'm not going to go into any detail here because my colleague Kaya is going to cover this in detail in his next topic. But there is a dividend allowance which started a few years ago at the figure of £5,000. Sadly, HMRC discovered that this was rather too generous very quickly and reduced it down to £2,000. But nevertheless, it's a useful figure, and Kaya will go into more detail about how this relief can be successfully utilised. Then we have the savings allowance, which is available to basic and higher rate taxpayers, not to additional rate taxpayers. So that's those with income in excess of £150,000. Just basic and higher rate taxpayers. £1,000 of your savings income, that will be mainly interest from banks and building societies in most cases. £1,000 of that is at a nil rate of tax if you're a basic rate taxpayer, and £500 of it is at a nil rate if you are a higher rate taxpayer. And finally, on this section, there are some allowances available referred to as married couples allowance, although that's a bit confusing because there used to be something called that in the past. But anyway, if either partner in a marriage or civil partnership is over 75, then there is the possibility of claiming this additional allowance, and it can save tax between about £350 and just over £900, depending on whether you're basic rate or higher rate taxpayers. So that's a brief walkthrough on personal allowances.
Thanks for that, David. And sorry, I should have said at the very beginning, we've got, if you've got any questions as we go through this, please do raise them through the little chat box that's there. It's Q&A, and we'll try to answer them as we go. If we can't, then we'll answer them at the end, which hopefully we'll leave time available for any additional Q&A at the end as well. And so just briefly, David, so in an instance where, you know, family-run business, which a number of our clients are sort of owner-managed family-run businesses, I imagine there's lots of opportunity there where more tax reliefs could be taken advantage of.
There is, particularly people should think about whether their wives and even in certain circumstances their children are in receipt of income and therefore fully utilising the personal allowance, the individual personal allowance. Because if they're not, then it can be worthwhile paying your wife a salary, perhaps if she has time available to help you in the business. And we even have clients whose children are, I mean, by children I'm talking about over 16, not minors, because there are rules about the amount of work minors are allowed to do. But as long as they're over 16 years of age, often this works well for university students. You involve them in the business during their summer holidays and you're able to pay them, and they have a £12,500 allowance available, and that can be a useful way of getting some additional income at no cost tax-wise into the family.
And a deduction for the business as well.
And a deduction for the business also, yes.
So, and I think it's important to mention that, you know, they should be carrying on work for the business.
Yes, I mean there needs to be it needs to be a certain amount of work done because it can be measured commercially by HMRC, and if they don't believe there's commercial grounds for it, then they'll disallow the deduction. Yeah.
Fantastic. Thank you, David. Kay, you're going to take us through dividend taxes and the release available there.
Yeah. Morning, everybody. As David said, thank you for giving your time today and joining us, and hopefully you'll be able to take some tips, some suggested allowances that you have not thought about or had thought about and were not clear on it. David covered quite a lot of the personal allowances. Why we kept the dividend tax out of that was because it's quite relevant to our client base, and I hope it's quite relevant and the audience will connect with it as well. Going back in time, dividends were quite an efficient way of extracting profits from your owner managed business, limited companies. They still remain to be the case, although the differential between taking a PAYE type remuneration versus dividend, the savings differential has narrowed down in favor of salary more now. But still, if you were to look at it on a very objective basis, numbers basis only, dividend tax, dividend route is still the beneficial one. Things changed from tax year 16-17 onwards, as David said. We used to have the tax credits built in dividends declared, because it was considered that you had already paid tax on the profits, or the corporate had already paid tax on those profits. And it came in with built-in dividend tax credits such that basic rate taxpayers didn't have any further income tax to pay. 16-17 change came about. We were given what was called a generous, and looks like generous, tax relief allowance, dividend allowance of £5,000 per taxpayer per tax year. It was quite a welcome for the portfolio investors type of client base, where dividends generated from their investment in listed stocks and shares would generate some dividend income for them. But for the owner managed business, who is using dividends as a profit extraction tool, profit planning tool, tax planning tool, it was quite a blow, worth 7.5%. I say 7.5% because that was the rate introduced on dividends, and it continues to be so. You pay 7.5% on basic rate of dividends, 32.5% on if you're a high rate taxpayer or part of your dividends that fall into high rate, or it could be as high as 38.1% for additional rate taxpayers. If you just go to the slide before at the moment, oh, fine. We can jump into the example as well, Tariq, if you want to take it on. The example we wanted to show here was to bring together some of the points that David had covered and what I was talking about dividend tax. But before we look into that, talking about the timeline, 16-17 was a 5,000 allowance, 17-18 remained the same, but for the last 3 years, 18-19, 19-20, and 2021, the current tax year, the dividend allowance with us is now £2,000, and hence the 5,000, as I was saying, looks generous now. It's reduced to less than half now. Nevertheless, it's still a valuable relief, and we come across cases or new clients we take and on board where even the £2,000 tax-free dividend allowance is not fully utilized or planned properly around the family members. So looking at this example on the screen, and it brings together some of the allowances David has mentioned as well. It looks too good to be true, but actually as a couple, where both are involved in the family business, owner-managed business, they can take home £41,000 tax-free. Now, some of you may be thinking it sounds too good to be true when the personal allowance is £12,500 and £2,000 of dividend allowance per person. Even if you double that up, it doesn't add up to £41,000. But hence we put this slide with the example there. The salary levels we have indicated in this example, there's always this classic question about salary versus dividend, or what is the best route, and we can talk about it, and no two cases are the same. So it's unique to your circumstances, and we always try and encourage to have that dialogue with the client manager or the client director to have a review of it every year. But in this example, what we have indicated is a husband and wife limited company operation. They take £9,500 as salary from their own business, which is fully deductible for their business and save corporation tax. At that level of salary, you're also making a very small NI footprint, getting your credit for your future pensions. Interest, and that's an interesting one, of £6,000, where you're using your starting rate of savings, which is £5,000. As long as your income does not exceed a certain threshold, you're getting that additional rate of 0% tax on your savings. This was brought in by the government to support the pensioners who relied on their savings income, and when the savings rate of interest dropped down dramatically, and it continues to be very low, and it's likely to remain very low for the near future, they brought in this special rate of savings rate allowance. The first £5,000 of interest earnings is effectively taxed at 0%. You also have the £1,000 as a basic rate taxpayer called the personal savings allowance. £500 if you are a high rate taxpayer, but in this case, because they both are basic rate taxpayer, we get the full 1,000. So £6,000 of interest that you can charge your own limited company because you've invested capital in your own business and you have a credit sitting there. Most owners don't consider charging their own company interest. And there's a little bit of compliance requirement there of CT61 that we can easily manage. But taking care of that, you can each take £6,000 tax-free from your own company, which is equally tax deductible for the company. Dividends, we used to show at £5,000, but obviously it's now come down to £2,000 dividend allowance wise. But because we are not using your full personal allowance of £12,500, an additional £3,000 is available to be offset, and hence the £5,000. It's not a typo, it's not a mistake. It is there for a specific reason at that level. So you still can get the same level of dividend allowance that was there in 16, 17 onwards. So 20,500 each, zero tax, zero NI, and of that about £30,000 is tax deductible for your company, saving £6,000 for your company in their taxes. The point here is there are so many allowances and so many different complex rules around it. So to get the right mixture for your case is quite important, and hence for somebody who knows their allowances, it's quite useful to have a look. Tariq?
Fantastic, thank you very much. I think that slide that you've put together is very clear, very informative, and yeah, incredible. 41,000 extraction without paying any taxes. I'm sure there's a lot of people that don't know that, so it's very good. It's interesting. I read an article just yesterday, and it was comparing the amount of taxes that we're paying today with the 1940s, and you know, if you see all the politicians speaking over the past 10, 20 years, you think we're paying less tax now than we were back then. But relatively speaking, as a percentage, the amount of tax we're paying in the UK has gone up quite a bit, quite a few percentage points compared to the 1940s. But equally interesting, we're still one of the lowest payers of tax in Europe and certainly in developed countries. So despite the pain that we all feel we suffer, we are not as bad off as some. Anyway, moving on.
Before I let you go, I know we agreed that we'll try and not mention COVID in this webinar.
That's right, yeah. It was COVID-free zone. Should have said that.
Without mentioning it too much, I think so. What is relevant there with the previous screen there was many individuals we know in the current economic climate are facing redundancies or whatever, and are looking at going on their own route. And if they are considering opening up their own limited company for doing consultancy work or starting their own businesses, what that indicates is on a much lower earnings threshold. However, your take-home pay could probably be the same or even enhanced compared to a much bigger PAYE package.
Yeah, absolutely. I've just got a quick question coming from Nizar. How can we get a copy of the recording? I'm assuming he really liked that slide too. Okay, so Nizar, this will be available on our website. It'll be uploaded probably, because it's quite a big file, it'll probably be during the course of tomorrow, but we'll try to get it up there as early as possible today. But expect it to be on our website by tomorrow. Okay. Thank you. David, over to you. Inheritance tax. We said death and taxes, and this is the.
Yes. Now I'm going to talk to you for a short while about inheritance tax, and I know that this is a tax that a lot of us focus on quite heavily because we're all naturally concerned to leave as much of our wealth as possible to our descendants, and also because this tax, possibly I may suggest, seems a little bit unfair because it's taxing wealth that we may have managed to accumulate, but only after paying all of the other taxes that exist. So I think we all struggle to understand the rationale behind wealth taxes, but nevertheless we have to live with them. The other thing about inheritance tax, which focuses the mind, of course, is the flat rate of 40%. Which is a very high starting and ending rate for any tax. So how can we deal with this in terms of allowances? Well, there are two main allowances available against inheritance tax, one of which is the basic tax-free threshold. That figure is £325,000, which I think shows on the next slide. And it hasn't been altered, this basic threshold, for many years. Now, as a result of no alteration of the threshold, effectively, people with things like residential property, which many of us do have, were seeing an effective increase in their latent inheritance tax just naturally because of the increase in value of their property. And of course, that has a that has a particular resonance south of Watford, where we all know that property tends to be rather more valuable than in the northern part of the country. But nevertheless, HMRC have frozen the threshold at £325,000, and that has been the case for quite a long time. They did, however, bow to this pressure about people's residence and the impact of that on their estate at death by introducing something called the additional main residence threshold. Now, this was introduced in the tax year 2017-18 and is an additional amount of tax-free allowance available where there is a residential property within the estate that is left to direct descendants. Now, it tends to only become significant, this relief, on the second death, because obviously, generally speaking, married couples will leave their property to the surviving spouse, but on the second death, that property is very likely to go to lineal descendants. Now, that lineal descendants could be defined as your grandchildren, your children, and any spouses or civil partners of your grandchildren or your children. So in most cases, that is going to cover the beneficiaries of a main residence within an estate. And from 2017-18, they introduced an additional relief of £100,000 available to each individual, rising by £25,000 per year to a maximum figure, which we're in the year we're now in, 2021, that figure has now risen to £175,000. So you will see, those of you who are very quick at mental arithmetic, that if you add that to the basic threshold of 325,000, we each have tax-free allowance against our estates if we have a residence in the estate of £500,000, which is why you'll often hear it said these days that anyone with property up to £1 million won't pay inheritance tax on that property. They may on some of their other assets, but not on that property. Now, an important thing to bear in mind, rather similar to what I was telling you about the personal allowance, is that there is a level of the estate at which they start withdrawing the additional main residence threshold. This doesn't affect the basic threshold, but it affects this additional amount. And that figure is £2 million. So if your estate exceeds £2 million, you will begin to lose the additional main residence threshold at £1 for every £2 by which the estate exceeds £2 million. So that at £2,350,000, effectively, you've lost this additional relief. When they introduced this relief, they did introduce an additional measure for those who had downsized, recognising that in later life, generally speaking, we may sell a matrimonial home and move to something smaller, perhaps a flat or a maisonette, and that releases equity, capital, into the estate, and it was deemed that it might be unfair for such people to have to pay tax on that equity, that capital that they released into their estate, just because they downsized. So if you've downsized since the 8th of July 2015, and you may well be called upon to demonstrate this to HMRC, but if you have downsized since, and as a result of that, some of the additional main residence relief is not then available to you because of the lower value of the property that you're now, excuse me, living in, then you can make a claim for downsizing relief, which will take that additional main residence threshold figure back up to the full amount, providing obviously you meet all of the other criteria. So that's an important one to remember. I think it was a welcome addition to the additional main residence relief. And finally on this topic, I want to talk to you about, because it's relevant to both these reliefs, I want to talk to you about what happens if on the first death, which is very common, everything is left from the spouse who's deceased to the surviving spouse. Now, in that circumstance, of course, no inheritance tax is payable because interspousal transfers are done at nil cost in terms of inheritance tax. So in fact, on the first death, and sadly, it's generally us chaps, but anyway, won't make too much about that. On the first death, very often everything is left to the surviving spouse, and therefore the deceased spouse has not used either of these reliefs. In that circumstance, when the surviving spouse passes away, they can claim at the current rates of threshold, and that's important because actually this can mean that the deceased spouse ends up with greater relief than he would have done if he'd utilised it at the time of death. Little did he know, of course. But you can claim on a percentage basis, and I'll explain in a moment in simple terms how this works. You can claim a percentage of these thresholds. The surviving spouse can make a claim. So let's take an example of where on the first death, and we'll say husband, but it could be the wife, only utilises 50% of their basic threshold or their additional main residence threshold. On the second death, the surviving spouse can then claim 50% of whatever the current threshold figures are against her estate for inheritance tax, or well, her executors will do this, of course, because she won't be around to do it, or he won't be around to do it. So all is not lost in situations where the first deceased spouse has not made use of these reliefs, and that's an important thing to bear in mind. And both that spouse's share of basic threshold and additional main residence threshold are carried forward in that way, and can help to mean that the surviving spouse on death has an estate that may be free of inheritance tax, or certainly helps to reduce it significantly.
A quick question, David, that's come up from, so two things. So Vic has asked a question which is related to some of the things that Kay was talking about earlier on. So we'll come back to that towards the end, but relevant to this particular topic, I've got a question from Rashmi. I think the answer is there's nothing special that can be done, but what happens when a person leaves their estate to somebody unrelated to them, to a friend or a godchild or something of that nature?
Well, certainly the basic threshold isn't affected by that, but unfortunately the additional main residence threshold, the rules are very clear that it only applies and it's only available when you leave it to what's called a lineal descendant, which is children, grandchildren, or the spouses or civil partners of children and grandchildren. Or it could be great-grandchildren, but it's this very strict lineal descendancy. And I'm afraid if the beneficiary doesn't fit that category, then the relief is not going to be available.
Okay, very good. Thank you very much, David. Kaya, you're going to take us through the R&D tax credits, which I'm particularly interested in this, having spoke with a gentleman yesterday about the relevant topic, and I know it's a particular area of strength of yours, Kaya, so please take us through that. Thank you.
Yeah, thank you, Tariq. Yeah, we are very passionate at Macalvins about this tax relief. Current figures from Treasury and some research done by a couple of outfits indicate 84 billion of R&D tax credits remain unclaimed in the UK. Now, when we were discussing this in the office, Tariq rightly said if all of it was claimed, probably the government will have to look at how generous the R&D tax credit regime is. But what it highlights is a lot of businesses are unaware of this relief available, and you don't have to do anything different, and it's money sitting, and it's one of those rare reliefs where you don't pay less tax just because of that. You could end up with receiving some actual cash from HMRC, which is a very rare thing. So if we talk you through this, I think so it's so important, this one, and so underutilized. At Macalvins, we made it a real point for this year and for future to explore this side of the reliefs to the client's advantage, yeah, very much so. If we move to the next slide, please, if I can talk about the background of R&D, how we reached here. It's one thing to remember here, it's a corporation tax regime it falls under, so only corporates can benefit from this, not individuals and not LLPs. So sometimes it's a question or a point quite overlooked right at the start of the business when you're deciding what is the right structure for your business, self-employed partnership, LLP, or a limited company. If you are going to be doing some kind of research and development work and you believe you could qualify for this, worth considering and speaking to your advisors or us about the right structure, and limited company is the right structure for that. It has been there with us since 2000. It's mainly there for companies and incentivizing UK PLC, all businesses, to do more research and development work. Any scientific advancement in science and technology and is so important to UK economy that the government has decided to support it via this relief. How do you submit your R&D report? What is included? You need to give a bit of background of the company and the structure, and we help you through this process. Detailed nature of the narrative of the R&D projects that you are considering. And before we look at the technical criteria, which I'll touch upon in a minute, one important factor to mention here is the time limits. It's 2 years from the end of your accounting period. So clients who have got, well, we are 2 days away from July month end, but as old as 31st July 2018 year ends, which has already passed, and you thought nothing can be done about it. If you think you have spent money in the past in R&D activities, and we'll touch upon that in the technical criteria in a minute, you could still qualify. So practically 2 days is too short a time frame, but let's say August 2018 year ends are still eligible to put in their R&D claims for that year end. So that is quite an important point to bear in mind. Talking about the technical criteria, before I go into the details, one thing I would like to say, generally speaking, whenever I say R&D tax relief, the client's reaction or the look is, we don't have anybody, we don't have a laboratory, we don't have anybody wearing white coats in our office moving around doing some research and development. That is far from the truth. That is not needed. In fact, what you need in the current climate is your tech people working from home, or your subcontractors who you have hired to look at your processes or your products or your services to be delivered in a different way, in a more efficient way, in a more a remote way, because that's the nature of the times we live in. And all that development you're doing could qualify, because the technical criteria, the projects that need to meet is not very high. Of course, you have to have some genuine science and technological uncertainty that you're trying to resolve, bringing together two systems, trying to develop a new product, trying to improve an existing product for it to have a longer lasting shelf life, etc. They all would count. The knowledge that you're trying to develop should not be easily available in the public domain. That is one of the technical criteria that would remain. And there should be challenges, scientific or technical, that the team faces in that project. Failures are fine. A success of your project is not a necessity to claim the relief. Again, that is quite an important point clients overlook. They only talk us about when they are successful. Sometimes when the project has not worked, you don't see what reliefs are available on that spend. So technological failures are good. The more hurdles and challenges you have, the better for the project to qualify. And I was talking to a client the other week, and it's quite a different mindset you need. If you know from the very beginning what information we will require from you to do your R&D report, you need to log your technical challenges and failures more than the success, because once you get to success, it's very easy to, when I speak to the technical team, they want to talk about how they managed to resolve it. What they forget to document and log is the issues and the failures they had and the iterations they had to do to get to the right mix and the right technology. If we move to the next slide, please. Financial criteria. Now, very important, the R&D tax regime falls broadly into two different sets, one for the large organizations and one for the SME sector. We'll talk about the large one very briefly because that's not generally applicable to our client base or many of the audience here today. It's for businesses who hire more than 500 people, or their turnover is more than 100 million euros, or balance sheet is in excess of 86 million euros. But what happens at that level is you qualify for RDEC, Research and Development Expenditure Credit. And recently, as near as 1st of April 2020, this regime has been made more generous. It's gone up to now 13% of the qualifying spend is reimbursed back to the clients. But what is more of interest to us and our client base is the SME regime, which is for the balance part of it. So if employers hire less than 500 people and their turnover is less than 100 million euros. The way this regime works and the qualifying costs that will be available for R&D includes the payroll costs of the personnel involved in the project, even subcontractor costs, even though it's restricted to 65% of the spend, but it is qualifying, software licenses, consumables, other research, training, management, or recruitment fees. If you had to recruit staff, team members specifically for the R&D project, even those would qualify. One good practice is to keep timesheets if the same employees are going to work across R&D project and other normal projects to get a percentage split of their costs to be allocated to the R&D project. But timesheets are not critical. They're not the end of the world if you have not kept it historically. So financial criteria is quite generous and quite flexible for the right projects once they qualify. And at this stage, I should also mention the advanced assurance regime that HMRC has been running since November 2015. And it's quite popular now, especially as the compliance check regime on R&D side gets a bit stricter as there has been some fraudulent activities, and HMRC are aware of it. If we move to the next slide about the financial computation, what qualifies and what will you get? Well, very brief answer to that is for every £1 you spend, you could benefit as much as 33p back from HMRC. Now if that doesn't excite a startup, an entrepreneur, or an ongoing business investing in R&D, I can't imagine what else will. It's such a generous relief. The way it works is for every £1 you spend, HMRC allows you to get an enhanced expenditure and gives an extra weighting of 130%. So in total, 230% of that expenditure is available as R&D qualifying expense. For loss-making businesses or startups or research pre-revenue days, there's an incentive given by HMRC where you can surrender those R&D claims and get a 14.5% equivalent in hard cash back, which is the 33p in a pound I talked about. I mean, we all know the importance of cash flow, especially in this time, and for startups, that is the key between a make or a break of their business. And getting this money, capital injection back in their businesses is so crucial, we have found, for a lot of our clients we have worked with. The RDEC financial calculation is relatively straightforward. It used to be 10%, it moved to 12%, and now it's at 13%. One point to mention on the financial calculation, and I touched upon the fraud, which HMRC estimates is in the region of £300 million, not a small number. Hence, from 1st April, they have tightened the regime to a 3 times multiple of a cap of the PAYE and NI cost of the business. It's not a new thing. It used to be part of the R&D tax credit regime in the past. They got rid of it, but they have reintroduced it from 1st of April 2020. However, the difference is this time they made it much more generous. It's 3 times, whereas earlier it used to be just your PAYE and NI bill of how much you could claim. But still, as I said, we have 2 historic years still to deal with. It's only for accounting periods ending on or after 1st of April 2020 that the cap applies. And because of the cap applying, in fact, there is a commercial justification to probably look at your R&D spend and research whether a surrender of the R&D is more beneficial or carry forward of how the R&D tax credit should be used, because you can carry back the losses. If you had paid taxes in the previous tax year, you could carry it forward if profitability is guaranteed, because that is more beneficial at 19% savings than 14.5%. You could also surrender it across the group if you happen to be in a group structure and there are other businesses in the group which are profitable and paying corporation tax. So there are various options to use it, and it's quite flexible. That's the real takeaway to take from today.
Okay, just a quick question for you on that. So if you take the cash up front because you're making losses, the deductibility of that expense is gone for subsequent periods completely.
That is correct. You surrender those losses effectively, and you weigh your options and you say, I'd rather have 14.5% back now in my bank account rather than take the risk of becoming profitable and wait for that 2 or 3 year period when I could save 19% or the equivalent of the corporation tax rate at that point.
Okay, great.
This last slide we have, which is quite a practical one, I think, because everybody likes this, but it's getting the mind ready about whether their business qualifies for R&D tax credit or not. And we have put a key questions here that the business owners should be asking themselves to identify any R&D projects in their own business. Have you developed your own software? Have you tried to do something different with different softwares in your business? Internal processes that reduce costs or improve production time, anything to do with efficiencies or improving efficiencies, trying to do something that is considered as a bit unpredictable. You don't know the outcome from the very beginning, and you try and research about it and try and engage professionals or talent to help you get to that solution. Any design work, anything that relates, I mean, I'm not going to read through all the 7 questions, it's there, but businesses that regularly generate patents, IP, 2 or more technologies coming together and trying to make it more efficient. What I would like to do at this point is also talk about some cases that we have done in industries that people will find it surprising that we have identified R&D in. Fintech recently has been a sector where we have seen a lot of movement, a lot of momentum with R&D tax credits. Surprising one, David, one of your client in the demolition stroke construction business recently put through a large R&D claim with us. Food production, we have seen business consultancy businesses developing their own bespoke systems and softwares have qualified. So the range and breadth is quite wide. So don't restrict yourself thinking we don't have an IP or we are not into writing softwares or we are not into pharmaceuticals and hence we don't qualify. These are the key questions to consider, and chances are your businesses have not claimed some of this £84 billion of unused allowance.
Yeah, so I think everybody, if if you think that you've got something that might, you're not sure, you think it might qualify for this, then feel free to pick up the phone. We've got a few checklists that we go through, some very straightforward questions to just give a sense of, yeah, this is likely to be something that's worth spending some time on and seeing whether there's a claim available for you. And we'll have that sort of 15-20 minute chat with you at no cost. So feel free to pick up the phone, Kaya, David, or one of your client directors, and they'll put you in touch with the right person to help you with that. Okay, Kaya, thank you very much for that. We're running a little bit late, but we're going to try and get through everything, and I've got a couple of questions at the end as well. David, capital allowances, thank you.
Okay, thank you very much, Tariq. Just very quickly to reinforce what's just been said about R&D tax credits. The client of mine in the demolition industry that Kayor just mentioned, 2 years claims, R&D claims that have gone in recently were worth £300,000 cash. That's not the amount of the claim, that's the cash equivalent of what those claims will be worth. And this is not a large client. By definition of the Companies Act, they're a small company. Anyway, just wanted to make that point that these figures can become quite significant.
Big win for difficult times.
Yeah, I'm going to take you through capital allowances as briefly as possible, mindful of the time. So the next slide just will basically show you the capital allowances that I want to talk about today. And they're in really order of what they're worth to you as business people. The AIA, which is the Annual Investment Allowance, is the biggie, if you like. It's replaced what used to be called first year allowance. It's available on what we call plant and machinery, but plant and machinery in use within a business, and that would include certain commercial vehicles as well, such as trucks, lorries, even vans, providing they meet certain criteria. And this allows 100% deduction for the business against its taxable profit of the cost of that asset. So it is indeed a very valuable asset, very valuable allowance. It's applied pro rata, and I don't want to go into too much detail about that, but if you have a short accounting period, shorter than 12 months, for example, or a long accounting period, then you pro rata the amount that's allowed, because there is a cap of currently £1 million. However, the government have already announced that that's going to reduce to £200,000 of expenditure from January of next year. And this is where the proportionate adjustment will become significant, because if your accounts span the two periods, one where there was £1 million of allowance and the other where there was only 200,000, you have to pro rata the period. So if you haven't claimed 100% of an item because it doesn't fit for annual investment allowance, then you're entitled to what's called writing down allowance. And writing down allowance, you either have the main, what's called the main rate pool, which is a writing down allowance of 18% per annum on the item. And the main rate pool is basically a catch-all of all of the assets that don't fit into the special rate or the single assets pool, which I'm going to talk about now. So if they don't fit into either of the special rate pool or the single assets pool, they go into your main rate pool and you can claim 18% of the cost per annum. The special rate pool includes certain items. One, which is what's called integral features of a building. So we're mainly talking here about commercial buildings that are in use within your business. And integral features, and this is often missed as a potential claim by businesses, things such as lifts and escalators, space and water heating costs, air conditioning and air cooling systems, hot and water systems, electrical systems, and the cabling and the sockets and so on. All of those items are by definition integral features within a commercial building. And if you have those in your building, you are entitled to claim capital allowances on them. And if you haven't done, then please do talk to us, because it is often something that is missed. I said that this mainly applies to commercial properties. There are a few residential property areas that fit under this category, such as furnished holiday lettings, because they're treated as a business, hotels and guest houses. Items in common parts in a residential property. So if you've got a block of flats and any of the integral feature items that I've mentioned appear within the common parts, they could qualify for capital allowances. And there are also special rules for residential care homes, which are too detailed to go into here. But if you're in that category, please do talk to us. Other items that come under the special rate pool and qualify just for the 6% writing down allowance would be long life assets. So these are assets which are deemed to have a useful life in excess of 25 years. Thermal insulation of buildings, that one's a little bit esoteric, but if you spend money thermally insulating your building, there are allowances available for that cost. And cars which have a cost in a CO2 emission, because we no longer look at the cost of vehicles, we look at how much CO2 they pump into the atmosphere. If it's more than 130 grams per kilometre, then they have to go into the special rate pool and only qualify for a 6% writing down allowance. Then we have the single assets pool, and this is either 18 or 6%, depends on the nature of the asset. This includes short life assets, obviously as distinct from long life assets. Those are assets which are deemed to have less than a 25-year life. And the advantage of classifying an asset as short life is that the pool ends when you sell that asset. So they're individual pools of money. They end when you sell the asset, and effectively that can shorten the period over which you receive relief for the whole of the cost. Because if you've only written it down for a couple of years and then you sell it, any allowance that's remaining will be allowed in that final year. So worth looking at whether you can classify an asset as short life, because it can accelerate the capital allowances that you're allowed to claim. And obviously that has a tax benefit. Capital allowances that can be claimed over this shorter period do not include, I'm afraid, motor vehicles, do not include items on which there's any use outside the business, because as you may or may not know, if there's any sort of private use on an asset that you're claiming capital allowances on, you have to restrict the capital allowance by the amount of private use. So if you use it, for example, 75% in the business and 25% personally, you can only claim 75% of the available allowances because of that private use. Also, any assets used outside the business can't be claimed as short life assets, as I just said, but have to go into a single asset pool nevertheless. And the final item I wanted to mention under capital allowances is a relatively new one, which is structures and buildings allowance. We used to have something, those of you old enough to remember, called industrial buildings allowance, and it's rather replaced industrial buildings allowance. It was introduced in 2018 and it was introduced at 2%. So effectively, you were writing off the cost of a commercial building used for your business, or the cost of converting or improving a commercial building used for your business by 2% a year. It would take 50 years to get full relief. It's now been increased to 3%. So over 33 1/3 years, you will have received full relief under structures and buildings allowance. And this is only for qualifying expenditure which has to have been incurred after the 29th of October 2018, when the SBA was introduced. One final thing I want to mention to you, because I think it's quite topical, and it does border on this topic of capital allowances, is electric vehicles. Because it is well worth considering electric vehicles, if not for political correctness reasons, then obviously because very generous capital allowances are available, particularly for ultra low emission vehicles, such as electric only vehicles. And also bear in mind that on an electric vehicle, including some of the plug-in hybrids with very low percentages of CO2, there is no benefit in kind charge, or a very, very small 1 or 2% benefit in kind charge for the private use of that vehicle. So it does make them a very attractive proposition. Thank you.
Great. And just on the zero emission cars, David, and you were talking about the capital allowances and the deductibility. So it's the same split there. If you're 50% personal use, 50% business use, then you only get a 50% deduction.
Absolutely. Any asset at all that you use outside the business, so for a personal use rather than directly for a business use, you must apply that percentage to restrict the allowance you claim.
Great. And I think for zero emission cars, it's subject to that personal business use split. It's a full deduction in the first year of purchase.
Absolutely, 100%. 100% allowance is available for electric only vehicles, like a Tesla, that kind of thing.
Yeah, and it's surprising what cars you can get. I mean, I was, I had some cars thrown at me from one of these leasing companies. Keep sending me emails and telling me what the taxable benefit is on different cars. But there was a very sporty BMW that effectively qualified for just 6% tax.
And the 100% allowance is available up to 50 grams per kilometre of CO2 emission. Yep. So not only the pure electric, but some of the plug-in hybrids are below that level and also will qualify for 100% write-off in the year that it's brought into use within the business.
Okay, brilliant. So I got a question here that Vikas raised quite early on, but just after we were going through the subject. So here it relates to what Kay was talking about, but also touches obviously on David's personal allowances. So the question is, if we engage kids, say kids, I haven't got an age here, so kids during the summer holidays to do some project work for the firm, is that deductible? Do we need to run PAYE on them? Do they need to file a tax return? And what is the age that child needs to be for them to be able to work within the business?
Okay. Well, from my perspective, I would reiterate the point about be very careful with minor children, because there are strict limits on the amount of time that they are allowed to work. That's employment regulations, so you need to make sure that you're not falling foul of that. But there is a way in which, providing they can sign a declaration to say that they will not earn more than the personal allowance amount within the period. And if we're talking about, I use the example of university students, for example, they can probably only perform this work in perhaps a 6-week period in the summer and maybe 2 or 3 weeks around Easter. Now, ordinarily speaking, that won't take them above the personal allowance, which means there is no need to run them through payroll, because they won't come in, they won't have taxable income.
Okay, so but I guess 16 plus, there's not really an issue, no. Obviously.
But you have to be careful, and one mustn't be silly about this, because it's no good putting a 5-year-old child down as having assisted you in your business. I think
technically they have a personal allowance.
Yeah, you got to be sensible.
Yeah. Okay. Be the highest paid paper delivery guy. £1,000 a month.
Just to add to that is, for minor children, the dividend allowance can be used. It's not straightforward for parents to give shares, but in the right circumstances and involving grandparents or other family members, you could actually use the £12,500 towards dividend extraction, rather, if you can't pay them salary, even as minors. And we have seen that it's not on the agenda today, so I won't go into too much details, but as Educator Trust and London and around London, private schooling is popular and not cheap. So the one provision to that income earned by minors is that the income should not be then used by the parents. But if they are in private education, something what we sometimes refer to as an Educator Trust type planning is quite effective. So if that is of interest to somebody offline, we should take it forward.
Okay, so I've got one very final question, and then we do need to end, because we're on the hour, which is a bit long. In fact, now lots of questions are coming in. I don't think we're going to be able to answer all of them, unfortunately. It would be great if they come through a bit earlier. But so one question from Jane, which is, your wife child works in the business. Do you have to keep timesheets to prove the work that's been done? I don't think you have to, but it would probably be useful just in case, it was questioned at some point in the future. I think that's probably the...
Yes. I would agree. I would agree that if in doubt about record keeping, do keep some kind of record. I mean, that takes me back to something I talked about earlier, which was this ability to claim unused relief for inheritance tax if it hasn't been used on the first death. There are certain documents that will have been created on that first death, which it is recommended that you keep in order to justify that claim later, such as marriage certificates, death certificates, copy of the IHT forms that were submitted. It's always worthwhile keeping records when you know that they may be needed, or suspect that they may be needed in support of a tax claim of any kind.
Great. Okay. And Shiraz has asked the question, which is around 100% allowance on electric vehicles that are leased. I think it's a straight answer. So Shiraz, can you just maybe drop a line to Kaya at the end of this, and he'll give you a quick, short answer, but it's not that straightforward. So not enough time really to answer that today. Okay, so thank you everybody for joining. That's all the attendees, but also to my colleagues for taking us through those various topics. It's been very, very useful. If you have got any further questions, drop us a line. Our contact details are there. There will be a copy of this whole presentation, well, the video, the webinar, on our website, hopefully by the end of today, but in any event by tomorrow. So do feel free to run through it again if there's any things that were not quite clear or you didn't catch at the time. There's some great slides in there, I think, which will be useful. And like I said before, pick up the phone to any one of us or to your client director, who will happily help you on any particular areas. This is all general guidance, I would say, so it's not specific to any of your personal circumstances. So you do need to bear that in mind. And just leave on the point about R&D tax credits. We'll send out an e-shot in the next couple of days, but with something that might help you identify whether you would qualify for that. And if you do, then please be in touch. Nothing else to say after that. Thank you very much, everybody.
Thank you.
Thank you. Bye-bye.